Hey everybody, John the Economist here, and today's topic is going to be inflation. Before we get started, just go ahead and leave a comment, like, subscribe, all that jazz. This is a new channel, so every little bit with that stuff helps. Anyways, let's get into it. So, one of the main reasons that I decided to do this video is one, inflation's obviously been a really hot topic. I think even, if you aren't interested in economics or finance, this has been a topic that everybody's been talking about because it's been affecting just about everybody's lives to some degree or another. So, one thing that I want to talk about is just talking about inflation from an economist perspective and just mention a couple things, a couple nuances that you potentially aren't considering and talk about how that actually affects the larger picture, affects how you can respond to inflation, clear up some differences in definitions and things like that. So, the first thing that I want to get out of the way is talk about the term inflation and what that actually means. Inflation is defined as the general rising of prices. It's not the devaluation of the dollar. And don't get me wrong, the dollar can devalue, and that usually implies inflation. But defining it as the general rising of prices is important because, for example, the United States has had a higher inflation rate than El Salvador, whose national currency is the United States dollar. El Salvador's inflation over the past year has been about 3.5% year over year, and the United States has been about 7.5% year over year. So, just something worth considering is that when we talk about inflation, it's not necessarily talking about the devaluation of the dollar. Usually that's implied, but what it's actually talking about is the general rising of prices in a market. So, with that, there's also this idea of the money supply versus the implied inflation. And what I want to show with that real quick is taking a look at the money supply over the last year. And I'm going to go ahead and just pop over to this Fred graph real quick, just so you can kind of see big picture. This trajectory has been increasing at a crazy rate over the past 40 to 50 years. Ever since we got off the gold standard, it's just kind of accelerated, right? You can see a pretty major shift in the acceleration starting in 2008 with the financial crisis, and it's gotten exponentially worse with the 2020 crash. We printed an absurd amount of money starting in 2020, and you can literally see where that happens. And we haven't really looked back as far as, also maintaining a higher rate of money printing than we generally do. And then we're going to measure that, though, versus the consumer price index. So, taking a look at the money supply here, since March 2020, when we really decided to embrace this very heavy level of quantitative easing, the money supply has increased about 40%, which is absolutely absurd. That means 40% of all money in circulation today has been printed in the last year and a half, roughly. And then we're going to measure this versus the consumer price index, which you'll be able to see is only about 10%, right? So, what that's implying here is that increasing the money supply doesn't inherently cause inflation. These two things are very closely related to one another, but one doesn't necessarily directly cause the other. If you have a 40% increase in the money supply, that doesn't necessarily mean that you're going to see a 40% increase in inflation at the same time. Additionally, inflation usually lags after that increase in the money supply. We really started experiencing the serious level of inflation like 6 to 9 months after this massive increase in the money supply. There's reasons for that as well that we're going to get into. So, why isn't this one to one though? And we're going to take a look at a couple things here. So, first of all, one of the main reasons why this isn't one to one is technological deflation. Now, what this means is as technology progresses and as an economy develops, there's actually a lot of deflationary features baked into that development. What I mean by this is take a look at what I'm doing right now. I have a camera set up. I have this microphone here. I'm sharing my screen with you guys, and I'm going to be uploading it to YouTube. And by all terms of all uses of the definition, we can kind of consider that a broadcast to a degree, right? In order to do the exact same thing that I'm doing right now, 20 years ago, it was worth hundreds of thousands, if not millions of dollars in order to put on a similar operation, right? You needed a bunch of very expensive camera equipment. You usually needed a crew to operate that camera equipment. You needed a place to broadcast, to the people with. Usually, the television was pretty much the only option at the time. All of these numbers of things that made doing what I'm currently doing right now significantly more expensive. Right, I have like $1,000 invested into this setup that's allowing me to do it. It's pretty low budget overall, and yet the quality of what I'm doing is comparable to the quality of what people were doing 20 years ago in a similar format. Obviously, not the same. I'm probably a little more rougher around the edges than a news anchor, but I digress, right? We also see this in things like computing power, right? So, computers 50 years ago had the same processing power as, you know, our phones were exponentially more expensive than what they would cost today, obviously. And on top of that, there's also this implication of what money that you aren't spending there gets freed up for you to do other things. So it actually opens up the amount of choices that you can make in the market, right? Because we as people are always making economic decisions at the margin. So now that you can save money on something that previously would have costed you a lot more money, you can allocate those resources towards other things inside of a market. It's opening up the number of choices that you have, which is directly tied to positive economic development, right? All of these things are deflationary. They actually do a lot to combat inflation, much more than people are usually willing to give it credit for. So that's something worth considering when talking about inflation and, how sustainable something like increasing the money supply 40% in 18 months is. And I'm not trying to imply that that's sustainable. Obviously, we saw 10% inflation. We definitely don't want to be seeing 10% inflation every single 18 months. That's 8% over our average price, our average target that we're at of about 2%. However, it allows a lot more leeway than people are willing to consider, which is why after printing 40% of new money, we're not seeing 40% inflation increase, right? The other thing that I want to talk about, which I think is super interesting, is the debt to GDP ratio. Because as you can see, we had this huge, and let me zoom in a little bit here. We had this huge run up, right, from about 108 to 135, but now we're at 122. So we've actually been able to half, the increase that we had with the 2020 run up. Part of this is due to the recovery from all of the COVID policies and things like that. The economy's back to humming pretty well at this point, so that changed this ratio in a positive way. The other thing that's crazy is that we actually printed so much money and had such a high inflation rate that it actually devalued the sum of the debt that the United States government was carrying, which actually reduced the debt to GDP ratio. And this has additional implications that are very interesting that I'm going to bring up later about what you can personally do to handle inflation. And none of this is financial advice. I just kind of want to mention a couple options, some things that people think about when it comes to this relationship of inflation, high money supply, and debt, right? So the other thing that's worth mentioning about just the United States dollar in particular is the fact that it's the world reserve, right? And that gives the United States a lot more leverage as far as how much they can print their dollar before actually causing high amounts of inflation. Other countries that, print a significant amount of money the way that we did, but don't have an economy as strong as the United States, or don't have their currency frequently denoted in the form of other currencies to figure out exchange rates, things like that, their inflation rates are significantly higher than what ours are, even if, the amount of money that actually got printed is comparable, right? So that's worth considering. So at this point, the Fed originally said that this inflation rate was transitory and it's all going to smooth out and it's going to be fine. And now they've kind of finally admitted, okay, this is here to stay and we have to do something about it. So what they're probably going to do is raise interest rates, which I think is something that everybody saw coming. The market has already priced it in. The market's been very spooked the past few months as far as the Fed raising interest rates because money isn't as liquid, which means that less money could potentially be going into assets, which scares people, and they go a little bit more into what's considered a risk-off environment, right? But what I thought was really interesting is this graph here, and I'm going to zoom in a little bit so you can see it a little bit easier. So this is the federal funds rate, right? So these are the interest rates that the Federal Reserve is charging. Obviously, you can see it's been basically nothing from the 2009 recession and this 2020 recession that we experienced. Then all these little wisps that you see here are the market as of February of each year, what their expected rate hikes are going to be, right? Because what I said was that the market already has priced in the rate hikes in a lot of ways. We've already seen a dip in the markets in anticipation for these rate hikes. But if history is any indication, we can also see that the market overestimates what that rate hike is going to look like, right? So we're hearing between 7 and 9 quarter% increases in the federal funds rate in the next 18 months or so, right? If that will actually be, what the Federal Reserve settles on over the next 18 months is yet to be seen. But looking back at history here, the market always seems to overestimate it, right? As you can see, like sometime in the 2000s, there was this expectation that the Federal Reserve was going to increase interest rates a lot over the next year, and it never happened. In fact, the Fed decreased rates for an additional 2 years before starting to do a more contractionary uh, Federal Reserve policy. And additionally, if you look at this 2009 to 2015 run, where the Fed funds rate was basically zero, you can see every single year they kind of expected there to be rate hikes, and it never really happened, right? I think the Federal Reserve's in a position this time around where they 100% are going to have to increase interest rates. However, the market is probably overreacting, right? Like I said, we could be seeing 7 to 10 rate hikes, but actuality, maybe we only see 4 or 5 in the next 18 months, right? Something like that. So the market's priced this in and overestimated it, and it's already very spooked, but that doesn't necessarily mean it's going to be sustained for the next 2 years. And while people sound particularly bearish right now in anticipation for these rate hikes, that might not actually be the case, right? Self-fulfilling prophecy in a way when it comes to the way that markets move and price in things like less liquidity going into the market. The other thing that I want to talk about is the inflation rate's short run effect on debt. And this goes back to the fact, which graph is it? This one, that we've reduced our debt to GDP ratio rather quickly over the past year or so since that run up in 2020. And what I want to talk about with this, and again, this is not financial advice, is that assuming interest rates remain in a stable place but inflation is continuing to be persistent, you can actually take advantage of the inflation rate in your favor by taking on debt. And again, not financial advice. But for example, if you took out a mortgage on your house and the interest rate on that was 2%, but you're seeing, say, let's even do a less crazy estimate than what we're actually experiencing. Let's say it's 4% inflation a year or 5% inflation a year. The money you use to pull out that mortgage on that house and own the asset of the home is worth more than the money that you're literally using to pay back. So you're actually getting a premium on the debt that you're taking out and then having to pay it back at a lower interest rate. Now, the caveat to this is that countries that have experienced really high levels of inflation, banks catch up to this trick and they will also increase their interest rates in relation to this. However, our inflation, relatively speaking, has been pretty modest, and I also don't expect it to be 7.5% year over year for 4 or 5 years in a row. I don't really think that's going to happen. I think it's slowly going to kind of return back down to maybe like 3% a year, maybe 2% a year, sometime within the next decade here. And with that, then you will have banks less eager to go and hike up their interest rates super high. I'm sure they'll increase as the Federal Reserve also raises their interest rates. Interest rates for everything else are naturally going to increase. That's kind of how that works. But there's definitely opportunities here when it comes to this relation between debt and inflation. It's an opportunity that our own government is currently benefiting from right now in reference to the debt to GDP ratio, and it's actually making our whole economic recovery in relation to COVID look a lot less depressing than previously anticipated, because we're actually getting this down to a more sustainable level. If we can get inflation down to a more sustainable level without experiencing, stagflation or anything like that, we're going to be on a much more positive road to recovery than people probably anticipated back in 2020. So this is all great news, and definitely interesting stuff to keep an eye on, depending on how you wish to navigate your market. The other thing that I want to talk about is just options to deal with inflation in general, right? I've made a couple posts where I just say, hey, if you held your money in a bank this year, then you lost 7% of the value of that money just by holding it there, right? Your money's losing its value versus the inflation rate, and you can do less with it. So, what are ways to combat that? So, again, not financial advice, but we have to kind of take a look at how the markets respond to something like this. And as you can see, we had this massive COVID scare, but with that, we've just been on a steady increase. And the contrast is even bigger on things like the Nasdaq or the S&P 500. I mean, the Nasdaq's just crazy. Like, look at that. Since we've rallied since the bottom of the COVID dump, 145% in 18 or so months, right? I mean, it's nuts. I guess it's been almost 2 years now, hasn't it? I'm saying 18 months, but gosh, it's been 2 years since March 2020, and I'm not getting any younger. That's unfortunate. Um, so a lot of people move to assets, anticipating increases in money supply because that increases liquidity in the market and these low interest rates. And a lot of people also, took a look at um, Bitcoin amongst all of this as well, because Bitcoin has a scarce supply and a fixed supply, and the anticipation is that fixed supply versus a money supply that looks like this is going to fare pretty well over time. So just things worth considering. People fly to assets when there's high inflation, high liquidity in the market. You might have missed that boat as far as like making absolutely ridiculously unprecedented gains. Wow, I am clicking everywhere right now. Excuse me. Um, but that doesn't mean that if you also still anticipate further inflation and further quantitative easing from the Fed over, say, the next decade or two, which, by the way, we've had these crazy run ups in our money supply twice in the past 14 years. So it's nothing to say that another one can't happen sometime in this decade. People usually look to assets for this stuff because these assets appreciate while holding it in a savings account doesn't. Um, and the other kind of scary thing is that, bond yields and things like that. I don't know if I have any bond yields. Do I? Yeah, bond yields also look like garbage, right? I mean, I don't think they're outpacing inflation in the slightest, and that's also worth considering. Generally, it seems like the more risk on some of these assets have been, like Nasdaq, right, primarily tech stocks and things like that. The more eager people are to fly to them when it comes to these massive liquidity injections into the market. But that's also, there's also cause for concern here too, because these tech stocks have not done well whatsoever against this news that the Fed might, get a little bit more hawkish in the near term here. Um, Easiest way to see that is by looking at, tech stocks like Tesla, right? Really been struggling lately. Um, Google's doing okay. Amazon rallied really well. Facebook's getting a beat down. I mean, sheesh, that's ugly. That's super ugly. So yeah, just worth considering though is, where can I shore up my money if a savings account isn't going to do that for me amidst high inflation and money printing, right? I don't think the federal government is going to stop the strategy anytime soon. It seems like they've leaned into modern monetary theory pretty hard. There's definitely pros and cons to it. I would argue more cons, but that's just my opinion at the end of the day. But one thing that is definitely true with it every single time is when the Fed starts running up its balance sheet and quantitative easing a significant amount, is that asset prices tend to appreciate. We're running at about 20 minutes here, so hopefully that was a good chunk of information for you, and hopefully you learned something about the way that inflation works, the mechanisms in it, the things that drive it, and hopefully what you can do to handle it a little bit better, because sometimes you kind of feel like you're at the mercy of just, you know, these ever increasing prices, right? I go to the grocery store and it feels like it's more expensive every time. It's super annoying. But thankfully, there are a couple ways to combat it. And additionally, I don't think the picture long term is as dismal as some people are making it out to be. So again, if you appreciated, my words today and enjoyed the content, just go ahead, like, subscribe, comment, all that good stuff. I very much appreciate it. And I will see you for a live stream next week. Catch you later. Bye.